into. A ratio analysis gives us an idea of a starting point for analyzing your financial situation. First one we'll talk about is your emergency ratio. Emergency ratio is liquid assets divided by non-discretionary monthly expenses. So liquid assets are assets that you can liquidate immediately. So what's the closest you have to cash? Of course, cash, green dollars, coins, currency. Then you go into what do you have in your bank, right? It's not the cash in your pocket, but you know that you can liquidate your account and get that money. So let's say you have $1,000 in the bank. Well, you count it as cash, but it's not cash. It's a digit in a computer. Until you liquidate that asset, it's not real. So when we do your emergency ratio, we need to know your liquid assets. So what it is you add up all of those assets, meaning cash, bank accounts, debit cards, money in the safe, or wherever you have some cash that's accessible to you, within a couple of days. So you got to think, this is emergency ratio. What kind of emergencies do you run into? Are you in an emergency where you need money now, somebody banging at your door, or are your emergencies like, wow, I need to pay this bill in the next couple of days? Well, that's how you need to judge it when you're going doing it by yourself. You need to consider those factors. So it's not just about a number, it's what do the numbers mean. So anyway, we add up those all your cash and come to what that total is of liquid assets, and then we divide it by your non-discretionary monthly expenses. Non-discretionary means I have no discretion. I cannot decide. I can't think about it. I must pay this. So these are monthly expenses. So expenses that you have no choice. You have to pay these expenses. So we suggest that this ratio of expenses cover 3 to 6 months worth of your fixed and variable outflows, the dollars that are going out. So what that means is how many monthly expenses do you have? What is that total that you have no choice but to make? And of those, let's figure in emergency, you need to be prepared to do that amount about 6 times. So meaning your emergency might last 6 months. So if your emergency lasts 6 months, then we need your money to last 6 months. So emergency ratio equals liquid assets divided by non-discretionary monthly expenses. That's going to give you that number. So that's the number that we need to have as an emergency fund. And this ratio shows us where you are with that. Are you lacking or not? Or, it's a snapshot. It tells us where you are. It's our judgment call to tell you whether it's lacking or not. So other ratio, housing payment ratio. Housing payment ratio covers all your monthly non-discretionary housing costs divided by your monthly gross income. These are some important ratios too. They're going to come into play a lot when you're pursuing a business loan, a home loan. All sorts of financial transactions are going to need this information. And so housing payment ratio equals all monthly non-discretionary housing costs divided by monthly gross income. And the suggestion that I'm making to you is that this ratio be less than or equal to 28%. If it's above 28%, you're in trouble. I mean, you're not in trouble right now, but from a budgeting standpoint, we're out of whack. That's a scenario that needs to be worked on. And if you're wondering, what does monthly non-discretionary housing costs consist of? That includes principal, interest, taxes, insurance, and any condominium fees. Think about that. That's part of your non-discretionary monthly fees. Yeah, I have to pay it. I don't have a choice. It's part of living here. All right. So if you're a renter, we still need to come up with this number, but this number would then be, the ratio would be the rent plus insurance divided by monthly gross income. It still needs to be less than 28%. All right, on to the next one. Total payments ratio. Total payments ratio covers all your monthly payments and your housing costs, just like the last one, divided by your gross monthly income. So this one needs to be less than or equal to 36%, and some prefer this even to be, some lenders and other entities might prefer this to be in the 28% range as well. But just think between 28 and 36% is common for a lender, and it's good for you to target. So again, total payments ratio, the ratio of your total payments to your income. All monthly payments, including the housing costs, divided by gross monthly income. All right, next one, solvency ratio. How close are you to insolvency, or how solvent are you, is what this ratio tells us. Solvency ratio equals total assets divided by total debt. So this needs to be less than or equal to 1-to-1 ratio. So important one there. It tells us a lot. Savings ratio is equal to the savings per year divided by gross income. So the savings ratio should be 8% to 25%. That's sort of an industry preference, but if you're a client of mine, we need to be definitely 8 is not good. We definitely need to be in a 10%, but 15 to 25 is where we want to be. And the more we achieve our financial plan, the more excess capital you're going to have from your income, whatever those sources are. And we want this ratio to be higher than 8 or 25%. We want to be investing half your income and you not feel it a bit. You're achieving all the goals you want to achieve. You're having all the fun you want to have. Remember, it's about achieving your goals, not just making money. You make money to do something with it. So let's achieve the with it. And we're going to make money to do it. But remember, the money is not the goal. The goal is the goal. So anyway, back to the savings ratio. Savings per year divided by gross income. Savings ratios will be 8 to 25% depending on your age. Your age is an enormous factor, because someone who's 18 may have a need for a different savings ratio than someone who is 50. Someone who's 50 is closer to retirement. Person who is 20 really don't know what they're doing yet. They don't have that much money. They're having fun. You know, part of life is experiencing life, so we can't just, you know, be at 50% of your income at that point, of course. But, you know, those type of people, a youth with a McDonald's job or something of the like, 8%, 10%, and you're still ahead of 90% of Americans just by doing that. All right, debt to income ratio. Debt to income ratio is your annual debt payments divided by your gross income, and this needs to be less than or equal 30%. We need to, you know, stay in that realm for you to be on solid ground. And the cash flow statement is where we're getting a lot of this from. Of course, the average person doesn't have a cash flow statement, so part of you getting with a financial planner, financial advisor, is to develop one. So this is part of getting a snapshot of who you are, where you are, what you're doing, and how you're doing. And these ratios help.